It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another weekend. Yes, it has dropped on the Real Estate Breakfast, your Australian property radio podcast, talking all about your national and local trends. Really do try to understand and navigate the real estate cycle and what is likely to happen next, hopefully free of any world shock events. And remember, you can now leave us a voice message. And if you are listening to us from outside of Australia or an expat, if you're migrating here, we'd love to hear from you. And of course, our email address is myrealestatepodcast@gmail.com. Yes, the weekend, it is a Saturday morning, October the 4th. A new report from the Australian Housing and Urban Research Institute shows that Melbourne's most, what they call service-rich suburbs. What is that? Firstly, we should explain that. That is a suburb that has strong public transport links. You know, things like quality schools, medical facilities and job opportunities. These are what they call cluster suburbs close to the CBD. But convenience does come at a cost. Domain data reveals that only Flemington, with a median house price of $1.07 million, is the closest to the Greater Melbourne median of $1.06 million. Other high amenity suburbs, just take your pick. The higher the amenity suburbs, you look at Toorak, 3.9 million, the median, Glen Iris, 2.2, Caulfield North, 2.1, and South Yarra, 1.8. So service-rich suburbs, when you break it down, it's probably code for adding more money onto your mortgage. It's more expensive where service-rich suburbs exist. Now, I did ask you what your thoughts were when it came to this week's decision from the RBA not to change the cash rate, therefore reducing mortgage repayments. Amy in Brisbane, thank you for your email. You said, funny how quickly they can increase the rate in an alarming way with little to no regard to the damage it causes for those at most risk. And the government, you say, needs to make a mandate for banks to keep the rates at the same level for those families who are most at risk, because it's breathing space for these people and will bridge between an extreme event to the market correcting itself. You say it's critical time that banks can, through a mandate, protect the vulnerable. I've got to say, that makes complete sense. I do agree that that would be a simple mechanism that would stop mortgages for some falling over and, more critically, stop the stress. Right, let's go to Sydney now and catch up with Tom Gibson from CBRE. And a very good morning and welcome, Tom, to the Real Estate Breakfast on our Saturday morning show. You're the Senior Director at Hotel Capital Markets. What does your job entail?
Thank you for having me. Yes, it's a very American title suitable for the American company that I work for. So my job as a hotel senior director at CBRE Hotels is to transact institutional hotels and resorts all through Asia Pacific, is the short way of saying it. In layman's terms, I'm a real estate agent focused in on the hotel sector specifically.
Now, give us an example of maybe one of the larger transactions that people will know, oh, yes, I remember that particular transaction. You were at the heart of it, and this will probably help break down for people exactly what it is that you're doing.
Absolutely. So hotel transactions, as prominent as the, obviously, real estate sector or other sectors, we see only a handful of large transactions take place in each year, and typically these will be well publicised, especially if there's a notable buyer behind it. One of the more recent transactions we were involved in was the Waldorf Astoria to Andrew Twiggy Forrest out of the Western Australian market. That was a hotel that broke a lot of records for highest price per key, highest individual asset sale for a market. It was a very intricate deal, being a development transaction, but it was one that was very exciting to announce when we were able to announce it.
Many people, they see these brands and there is this assumption that the hotel brand actually owns the site, and that is not the case. So just talk about that fundamental difference between the brand, whether it's the Waldorf Astoria, whether it's one of the other larger brands, and how that transaction takes place.
It's exactly right. So effectively, when you see the hotels on the Gold Coast, Sydney, New York, around the world, and you see a Hilton flag, a Sofitel, a Hyatt, whatever that hotel brand is, 99% of the time that is not owned by that brand. They are effectively a tenant, and the relationship between that and the freehold landlord is what we call a hotel management agreement, whereby the manager, being Hilton or Marriott, will operate the hotel on behalf of the owner. The owner is who I represent. So when we go in and transact on a hotel property, we represent the freehold owner. And that could be an ultra high net worth like Andrew Twiggy Forrest, or it could be a property fund. It could be an owner operator out of Singapore. There's multiple different types of ownerships that we deal with on our client base, but it's only for really strategic, highly strategic assets that a brand you'll see own the real estate, such as a property in Times Square, New York, or downtown London.
Developers, before they break ground, would they be engaging your services and saying, look, this is what we're going to build, and then you go off, perhaps even before ground is broken? Can you do deals where they've got that in place in terms of the tenant?
That's exactly right. So we come into the deal typically when a developer, on the development standpoint, will come into a deal when a development has identified a block of land that they think should be a hotel. What we'll do is a market demand study in that instance, where we look at the macroeconomic environment of that subject market and understand if there is a need for a hotel, and then further, what is the type of hotel that's required? Is it a 3-star hotel? Is it a Ritz-Carlton? Is it a Novotel? And we work back through to understand what's the recipe that works for developers, and from that basis it's then progresses to the relationships with hotel management groups that we would approach on behalf of a developer. So we would work with the developer to understand what their strategy is, to then go and have the conversations with Marriott, with Hilton, with Hyatt, with Accor, and say, right, here's a hotel, it's 200 rooms, it's a 4-star position product. What's your brand? What's a 5-year forecast look like? Please give me a proposal. From there, we'll effectively run an expressions of interest process, which allows us to extract the best terms from the market for our client. And then from that position, we can understand where the capital value sits upon building that hotel.
Yeah, I can hear mum and dad investors saying, well, this is something that we can't really get involved in. This is too big for us. But you could be surprised, mum and dad, because there's all sorts of funds out there and people will be part of those funds, mum and dad investors potentially.
It's exactly right. A lot of the property funds, especially domestic-based property funds in Australia, do deal with the hotel strategies that come into hotels for CBD markets. We don't see it so much in regional markets that are more leisure exposure, just given the risk that comes with, obviously, currency fluctuations, discretionary spending rises and falls. It's more sensitive in terms of performance, whereas if you're in a CBD market like Sydney or Melbourne, they're pretty bulletproof markets, and it gets a lot of interest from those property funds which have, smaller scale investors investing into them.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
Now imagine doing everything right. You have built a successful career. You've owned property in the past. You've never missed a repayment when it comes to mortgages, yet you find yourself shut out of the housing market at 52. This is the story of Justin. So why do you think the banks still see you as a risk at 52?
To be honest, I am really not sure. Like brokers who I've been dealing with, they've said it just comes down to serviceability. Being self-employed probably doesn't help me as well. Like obviously, put together a tax return that, financially works for me. Like it's all above board, but obviously you want to reduce your tax as much as what you possibly can. But the flip side of that is obviously it then looks as if your income isn't as high. So that's part of the problem. I would have thought the security in a property should allow me to actually be able to borrow a decent amount of money. I mean, at the end of the day, let's say I can't afford the property, which, I've never ever missed a repayment. Isn't that the whole reason that the property is secured by the bank? They'll sell it out from under you. I don't know. Maybe that's too hard work for the banks. They just don't want to do it. I know that's, a worst case scenario, and I couldn't imagine that happening. Yeah, I'm at a bit of a loss.
You're listening to the Saturday Property Market Update.
Yeah, and if you've ever dreamed of getting away to a place where the simplicity of life is waiting for you to turn up, well, there is a place tucked away on the Great Barrier Reef, Bedarra Island Resort. It has just got 12 villas across 45 hectares of rainforest. It has hosted the likes of Elton John and other famous faces. First opened in 1986, but now this celebrity-favoured retreat off Queensland's coast is preparing to hit the market. And you're involved in this one, Tom, so it just goes to show that it's not just the hotels. This is a resort, very secluded by the sound of it. You guys would be having a bit of fun with this, wouldn't you?
It is. Unfortunately, we do wear the suits when we're up on the resort, so it's not for all fun and games. Though, in saying that, it is definitely a fun destination to go visit, and one that has been an exciting campaign to get to the market. We're very lucky to be managing the sales campaign of Bedarra Island Resort. A bit of a history of that asset. It's a bit of a pioneer in the luxury lodge sector in Australia. As you said, 1986, it's had some pretty prominent owners: P&O Resorts, the large cruise line, GPT. And then to the now owners, the Charlton family, who have done an incredible job in running that asset and keeping its authentic barefoot luxury operation. It's not trying to be ostentatious in terms of its luxury. You can walk into the bar, grab a 4X Gold and drink it anywhere on the island with your partner. It's not designed to be a large family resort. It's about exclusivity. It's about taking in nature. One night there feels like a week, and it's the best part of the Great Barrier Reef there, just off Mission Beach, and it's a pretty special place.
And since COVID, people like to get away from it all. We know that celebrity star power, these sorts of islands are definitely attraction. Do you think that that's gone up in terms of marquee value for something like resort islands tucked away?
I think these assets were the experts in social distancing as we learned through COVID, and as we come out of it, and there's more of a demand for these type of destinations where it's more of an experience to be secluded and have great hospitality. And I think that's the market's definitely shifting that way, and we're seeing that across both leisure and CBD markets, where hotels are trying to focus more on the guest experience more than anything, and it's so crucial to nail that.
Well, thank you for telling us a little bit about what you're doing there at CBRE, and just in terms of some of the transactions, that kind of helps everybody, including me this morning. And thanks for coming on to the Real Estate Breakfast. Appreciate it.
My pleasure. Thank you for having me.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
If we're looking at 20% down in stock, effectively that will eventuate into a decent clearance rate. And frankly, this entire calendar year, the national clearance rate has been hovering around that 70 to 75%. And I don't see that changing, Craig, between now and the end of the year.
I just want to come back to, the times that we live in. It's like COVID was a long time ago in people's minds. It was one of those shock events that took place, but it can happen again. It's not beyond us. And I do worry about these very large mortgages that people will take on.
Absolutely. Look, when we say it could happen again, it will happen again. I've certainly auctioned off properties where owners have openly admitted, look, this is not going to be a capital gains or a profit exercise. It's just purely a reduction exercise, and I will be taking a haircut. But the opportunity cost of holding it is just too high. I want to move on and do other things.
We connect you to the best real estate information across Australia. The Real Estate Podcast.